Welcome back to the Community Corner podcast, where we explore the companies in the S500 through the lens of behavioral finance. I'm Arnav.
And I'm Nikhil. Today, we're turning our focus to Bank of America, one of the largest financial institutions in the world, known for its comprehensive banking services, wealth management, and commitment to digital transformation. We'll be discussing how behavioral finance impacts their decision-making, diversity and inclusion efforts, adaptation to different markets, and how they compare to other companies in the industry. Let's dive in.
Bank of America has a long history and a significant presence in the financial sector, but from a behavioral finance perspective, how do biases, like risk aversion and the status quo bias, influence their decision-making, especially in areas like lending practices and investment strategies?
Risk aversion is a critical factor in Bank of America's decision-making, particularly in its lending and investment practices. The bank has a strong focus on maintaining financial stability and minimizing losses, which influences its approach to credit risk management and investment decisions. This cautious approach is reflected in their careful evaluation of loan applications and their diversified investment portfolio, which aims to balance risk and return. The status quo bias also plays a role in their strategy. Bank of America often favors maintaining established practices and conservative.
And this focus on risk management and stability has made Bank of America a reliable performer in the financial sector, appealing to investors who prioritize security and consistent returns, especially in a highly regulated industry.
Exactly. Bank of America's conservative approach to risk and its emphasis on maintaining financial stability appeal to investors who value a safe and steady investment. However, this approach also means the bank must carefully balance innovation with risk management, particularly as the financial services industry becomes increasingly digital and competitive.
Let's talk about diversity, equity, and inclusion at Bank of America. As a major financial institution with a global presence, DEI is particularly important. How does this intersect with behavioral finance?
Bank of America's approach to DEI is essential, especially given its large and diverse customer base and workforce. From a behavioral finance perspective, strong DEI initiatives can enhance the bank's ability to serve a wide range of clients and make more inclusive financial decisions. A diverse workforce brings a variety of perspectives to the table, which can improve decision-making, innovation, and risk management. For investors, Bank of America's commitment to DEI can signal that the company is socially responsible and aligned with modern societal values, which can enhance its reputation.
Investors are increasingly considering DEI when evaluating companies, especially in finance, where understanding and addressing the needs of diverse populations is vital to long-term success.
That's right. By embedding DEI into their corporate culture, Bank of America not only improves its ability to serve a broad range of customers but also strengthens its market position and attractiveness to socially conscious investors.
Moving on to global markets, Bank of America operates in more than 35 countries, offering a wide range of financial services. How does the company adapt to different markets, and what role does behavioral finance play in this?
Bank of America's global strategy involves adapting its financial services to meet the specific needs and regulatory requirements of different regions while maintaining its core values and financial principles. From a behavioral finance perspective, this adaptability is crucial for managing the risks associated with international operations and diverse financial systems. The bank's ability to navigate complex regulatory environments and tailor its offerings to local market conditions allows it to maintain a strong global presence while managing risk effectively. This approach helps Bank of America.
And this adaptability is essential for Bank of America, especially as they face competition from both local banks and other global financial institutions. Their ability to maintain their brand's trust and relevance in various markets is key to their continued success. success, and this adaptability is essential for Bank of America, especially as they face competition from both local banks and other global financial institutions. Their ability to maintain their brand's trust and relevance in various markets is key to their continued success, and this adaptability is essential for Bank of America, especially.
Exactly. Bank of America's focus on understanding local market dynamics and adapting its strategies accordingly allows them to remain a strong competitor in the global financial services industry while staying ahead of emerging trends and challenges. However, this also requires them to be proactive in responding to changes in global economic conditions and regulatory environments.
Now, let's compare Bank of America to other companies in the financial industry like JP Morgan Chase, Wells Fargo, and Citigroup. How do the behavioral finance dynamics differ?
Bank of America's dynamics are often compared to other banking giants like JP Morgan Chase, Wells Fargo, and Citigroup, particularly in their approach to risk management, innovation, and customer service. Bank of America's emphasis on risk aversion and conservative financial management appeals to investors looking for stability and long-term security. JP Morgan Chase, with its strong investment banking division and emphasis on innovation, may appeal to investors interested in a more aggressive growth strategy. Wells Fargo, known for its focus on retail banking, appeals to those looking for a more.
And unlike JP Morgan Chase, which has a strong focus on investment banking and innovation, Bank of America's strength lies in its comprehensive approach to retail and commercial banking, appealing to a broader base of customers and investors.
Absolutely. Each of these companies has its own behavioral finance dynamics that influence how investors perceive their value and potential risks. For Bank of America, the focus on stability, risk management, and a strong global presence provides a unique value proposition in the financial services industry.
To sum up, Bank of America's approach to business is deeply influenced by behavioral finance principles, whether it's through their risk management strategies, global market adaptations, or their approach to DEI. But like all companies, they are still subject to the biases and perceptions that can influence investor behavior.
That's right. Understanding these dynamics provides a clearer picture of what drives Bank of America's stock price and where the potential risks and rewards lie.
Thanks for joining us on this episode of the Community Corner podcast. Until next time, I'm Arnav.
And I'm Nikhil. Stay curious and keep questioning the narratives.